Corporate finance practice problem using OneNote. Owner sales company interest and tax obligations. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 2019 Owner Sales Interest and Tax Obligations tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top. We got the calculations on down below. We're looking at a scenario where an owner starts up a company, has the shares for the company, builds it up, and then thinking about selling those shares and then structuring the sale in a couple different ways to consider what might be some tax obligations in a scenario such as that. So we have then the investor helps to start up a company, has a startup company. The shares that investor owns is $118,000. The cost per share is $2, which is of course quite low given the fact that he started up the company, and now we would expect the price to have gone up a lot if he added value to the company so that when he sells the stock, then he could then have a significant gain, which could result in tax implications as well, of course. So he has an option to sell all shares for the amount per share of $57 per share. We're going to assume for the practice of this problem the capital gains rate at the 10%. Remember, when you're talking about tax rates, the tax law can change over time, but typically they're going to be changing things like, the capital gains rate. Often there's an argument for it to be different than the ordinary income rate. When you're talking about income taxes, dividend rates are often argued to be different than ordinary income rates, and so on. And the rationale for the capital gains tax to be different would be something like this, whereas this individual built up value in the company, and if he or she was to recognize all the gain in 1 year, because we have a progressive tax system, then it might result in him or her being in a much higher tax bracket than they otherwise would, when really the earnings that they earned happened over a long period of time. He might have had this company for like 10 years or something like that. And so the fact that he'd have to recognize it in 1 year, that's one argument for lower capital gains. Obviously, another argument, it would facilitate people to want to make deals like this if it was a less of a tax impact, which should be good for the economy and this kind of thing. So in any case, that's typically going to be the case. So we're looking at capital gains rate 10%. Instead of cash, he gets stock, the value at the 57. This would be option number 2, right? So we could say, okay, option 1 gets paid just straight cash for it, 57. What would be the tax on that? Option 2, we're going to say, well, what if instead of getting cash, he gets some stock? And what if he was able then to not have to recognize the gain when receiving the stock, but rather have to recognize the gain when he then sells the stock? So if something like that could be set up, then he would be able to defer the gain until the stock sale. So you'd still have to recognize it, but possibly being able to defer it. So instead, they get stocks valued at $57. We're going to make it nice and even, so the stocks that they're receiving is equivalent to the stock that he owns, and then he sells the stock 10 years later. So he's going to hold on to the stock for another 10 years before selling it. And again, we're assuming he doesn't have to recognize the gain in this case until he recognizes it by selling the stock. And then we're going to assume that the price at the sale is $75, which is an increase from the $57, but he had to wait 10 years to get that increase from 57 to 75. So would they be in a better tax situation if that was to play out in that format? And then we have the discount rate is 10% when we get to that second option. Okay, so let's figure out the gain here. We're going to say, all right, the sales price, we've got 118,000 shares. We're going to say, first of all, he just sells it. What if he just sells it for $57? So 118 times 57. So we're going to say, okay, 118,000 times 57 is going to give us the gain, or the revenue of the 6,726,000. And then we're going to say that the total cost is going to be the shares that they had, 118,000 times 2, because that was the cost that was had, which of course is quite low given he was a founder, we're assuming here, of the company that helped to build it up. And so that means we've got $236,000. So if they were to sell it at this point, we've got the 6726000 minus the 236,000 is going to give us then the difference or gain of 6,490,000. So obviously, if you recognize 6,490,000 in 1 year, that's going to put you in a substantial tax bracket. You can imagine a situation, for example, where someone's, paying like a normal tax bracket of like a top, an average rate of like, 15 or 25%. And then, of course, if they have this huge amount of income, it's going to have a lot more possibly tax at a much higher tax bracket, which of course would then disincentivize a transaction like this to happen. And the earnings of this transaction have actually happened over multiple different years, because however long the corporation was in place is when that gain took place. So in any case, that's one argument to having this different capital gains rate instead of the ordinary income rate, which we're saying is just a flat 10%. So we're going to say the gain is that 6,490,000. We'll say the capital gains rate is 10%. Then there would be a tax implication, which is multiplying that times 0.1 of the 649,000 on the tax. Now we can look at option 2 and say, well, what if, in some way he can get stock and basically instead of cash, and basically have a trade in that case, and possibly structure it in a way where he can defer the gain. What if we could set up a scenario like that? How would that look? Well, we're going to say then he got stock for it. We're going to say the same number of shares, 118,000, valued at the $57 at the point in time the sale was made instead of cash. Then he held on to the stock of another company, right? Not his company, but another company stock valued at the same amount. And then 10 years later, he's going to sell it for $75. So the value went up from 57 to 75. So let's think if he was able to defer the gain under that situation, we'd say then, all right, well then the shares are going to be 118,000. We have the share sales price at the 75 and the cost is 2. So 75 when he finally sold it 10 years after, and the cost, he has to keep the same cost. So if he was able to defer, then one of the things you got to do typically is keep the same basis and whatnot. So we're going to say the cost is still 2. And then the gain per share would be 73 per share. So 118,000 times 73 would be our calculation here. The 118,000 times 73, giving us the 8,614,000. So our tax then would be the 8,614,000. We're going to assume the same flat 10% rate times the 0.1. Obviously, tax codes could change over time. They could change rates over 10 years and whatnot if they decide to adjust the capital gains rate or something like that. But we're going to assume it's the same. And then the after-tax profit then would be the total gain of the 8 million minus the tax. So the total gain would be 7,752,600. Whereas up top, we had the after-tax profit, which we never finished, was the 6,490,000 minus the 640. That would be then a profit of the 5,841. So option 2 is clearly higher in a total dollar amount basis, but at the same time, the cash wasn't received until 10 years later. So you'd still have to think about, well, what about the time value of money? Because if he had the 5,841,000, could he invest that over the 10-year time period and get a return greater than this difference between the $57 and the $75? For that, we're going to assume the discount rate, the hurdle rate, the rate of return of 10%, and see if we discount this back using our present value calculations, which I'm not going to actually show right here, but the present value calculations we've seen in a prior section. If you want to take a look at those, we worked this in Excel too, if you want to see it in Excel. But in essence, we're going to take the present value of one of that 7,752,600 that's 10 years out. We're going to bring it back 10 years and at a discount rate of 10. And that would give us the 2,988,963. That amount being less than the $5,841,000. So under this circumstance, then we may still be better off with the first option to actually get this, even though the tax is, not deferred and whatnot, because if they can then invest that and get a return that we're assuming here of 10%, then they would be better off.